Oh, give me a second. We're live streaming right now, but let me change this. what's up, guys? We are live. Michael, how's it going?
Hey, going good. How are you, Austin?
Not too bad. Real quick, we got to hit go live on Instagram if you haven't done that yet. I'm just
Yes,
about to hit
sir.
that. Awesome. So we have people on Facebook, we have people on Instagram, on YouTube. I hope on LinkedIn. I checked, it seemed to be working, but we won't know till it's done.
Yeah, I see you. I see you on Instagram. Yeah, so far so good.
Awesome, awesome. Thank you guys for joining. Today's a Wednesday, right? This hump day Wednesday evening. Appreciate all of you guys jumping on here, and I want to thank you, Michael, for spending some time on your Wednesday evening with us as well. For those who don't know what this is, it's an Ask Me Anything. We're going to be hosting one every single month where I bring on a guest expert on a specific topic to help answer your burning questions on that topic. And because it's tax season, which Michael, you want to close your ears, but everyone's least favorite months. But hopefully, tax season will be a little bit better with Michael on here because he's going to give us some tips and tricks to help us have a better tax season and hopefully save a few $1,000s along the way. Michael, for those who don't know, he's a real estate investor and a tax accountant that works mainly with investors and self-employed clients. He's also a real estate investor, as I mentioned, and he's implemented the BRRR strategy to help grow his portfolio across southwestern Ontario. And eventually, he used real estate as a tool to quit his full time job and focus on running his tax return business full time, as well as invest in real estate. Uh, Michael, is there anything I missed there?
No, I think that's a great summary. Thanks, Austin. I'd say this was a natural kind of progression for me, starting out as an investor, still having my full-time job, being a CA by trade, doing my time, paying my dues at a couple of accounting firms over a decade, and then realizing that there was this great opportunity and this gap in our investor community where investors, self-employed individuals really were looking for good accounting, like not just an accountant to file their returns, but for advice and strategy. So it's been awesome since put the flag in the front lawn saying open for business, and I'm excited to be here. Honestly, this time of year, like January, February, accountants feel like rock stars because everybody wants a piece of them. Everybody is starting to look at their documents from the past year and start to organize things, and they have questions. So definitely excited to be here and to share like as much like tidbits as we can, where it's going to raise more questions in people's minds so that they know what things they want to plan for, other questions they want to ask their accountants, or if they want to reach out to me, I can definitely help them.
Awesome, amazing. And yeah, I know I leaned on you quite a bit asking you questions about like different things, Smith maneuvers, even when I was wholesaling and there were some who passed away, I was asking about estate taxes, tons of things, your book of knowledge. Can't wait to dive right on into it. Guys, if you don't know, this is a Ask Me Anything. So drop whatever questions that you have in the chat, whether you're on Instagram, on Facebook, or on YouTube, and we'll make sure to get right on into it. Let's jump into it right now. So we asked questions earlier on our Instagram for people to leave their questions with us. So this was a question that was asked on Instagram. What are the most important deductions that realtors and real estate investors should be aware of when filing taxes?
Yeah, I think that this is like, a cornerstone question because many clients or individuals that reach out to me, I think everyone always feels like maybe they are missing things. You don't know what you don't know. So this is where I've developed a couple of templates to kind of make sure that we catch as much as we can. Nobody wants to pay extra tax these days, right? I feel like we're getting hit with taxes everywhere. In terms of rental properties, right? If I look at a T776 statement, always the biggest expense is your interest, mortgage interest, HELOC interest. If you used any of that for your down payment or for rental funds, you have property taxes, repairs and maintenance, insurance. Maybe you have property management. Maybe you're covering utilities. Those are all the big ones. And then some people might have, some like legal and accounting or some office expenses or vehicles that we could throw in there. On the realtor front, which realtors are, I'd say, the large majority of my self-employed clients right now. I work with a lot of like construction workers and other types of self-employed people. But for realtors, I like to kind of summarize it as you have your main operational expenses. So you have like your marketing, professional fees, education, insurance, and then you have two additional buckets. You have all of your vehicle expenses that are going to be prorated and your office expenses, like home office. So we want to make sure that you're not missing anything there. Often I see people are, not having like a travel log. That's actually a common issue across everybody that I see. But that's in a nutshell, like some of the big buckets that you want to be aware of and tracking every year.
Awesome, awesome. I do want to dive deeper into that. So when we talk about real estate investors, there's a word that comes out pretty frequently: CCA depreciation. And maybe I'll make note of that here so everyone can see what I'm talking about. Would you be able to elaborate on what that is and how you determine if you're going to write that off or not?
Yeah, so depreciation is basically taking, either the value of the property or any other assets related to that property and depreciating them and using that as an additional deduction. So it's actually a cool benefit, if you will, of owning a rental property where every year you can basically decide to bring your net profit for your property down to zero if you want to. The tough part about it is if you do that and you do it for a number of years, all of those amounts that you've benefited from and paid less tax because of in those respective years, you are going to pay tax on all of those amounts in the year that you sell the property. So then not only will you have a capital gain in the year of sale, but you're going to have to bring into income and basically pay tax on all of the depreciation that you've claimed over the years. So it's kind of like a tax deferral, option. I'd say, 30 to 40% of my clients, assuming they have profit across their entire portfolio, claim CCA. The rest of them don't. They just, they're okay paying a little bit of tax that they need to on the property. They don't want to be hit with that larger tax bill in the year of sale. So it's really a personal decision. But one of the things I do, I like to educate people and kind of give them a lay of the land, just like I did on, here's the pros and cons, here's what it means. I think the people that are maxing out CCA are the ones that feel like every dollar today that I can save in taxes, I'm going to use to invest. I'm going to make a way higher ROI by keeping that money in my pocket. I'm fine with paying taxes down the line.
Mm-hmm. So let me ask you this. Does it, and this is just elaborating on that, does it matter what income bracket you're in at the time of when you sell the prop? Like, I guess what I'm trying to ask is, do you consider what income bracket the individual is going to be in, like if they sell the property 10 years down the line versus if they're in a high income bracket today, right? Because
Yep.
obviously, yeah.
Yeah, that's exactly it. So it's kind of like RSP contributions. Like you're hoping that right now, as you're contributing to RSPs, that you're, making more money, and then you're going to be in a lower tax bracket when you start bringing that money back into like taking it out, pulling it out, and being taxed on it. So you're kind of hoping the same thing here is that right now you get a bigger tax break because you're making the most money. You're making 150, 100, 200 grand, whatever it is. But then in the future, when you sell that property, maybe you're making less or you're retired. And so when you bring that recapture into income and you pay tax in that year of sale, you are paying less tax. So it's almost like a strategy where it'd be ideal if you sold that property, if you knew you had a recapture to claim in a year where your spouse is on mat leave, or you took like a year off, or you were on a break from work, whatever it is, because then you're in a lower tax bracket.
Awesome. So this question came in through Instagram right now. Again, if you guys are watching the live stream, your questions get prioritized. So make sure to drop the questions down there. Can you sell? I assume, can you sell a rental property to buy a primary residence without paying capital gains?
No, if you have a profit on the rental property, so your sale price minus your purchase price, minus any capital additions that you've had, and minus any like carrying charges, sorry, minus any like disposition costs, so your legal and your realtor fees, if there's a profit on that rental property, you need to pay capital gains first. It doesn't matter what you do after. Unfortunately, we don't have like a 1031 exchange here in Canada. You need to pay the piper. You cannot, delay or exchange. You could try to smooth it out. If it works for you, you could try to give a vendor take back, and that allows you to spread that capital gain over the length of the VTB up to 5 years. You could do strategic things like that, but you know what? A capital gain is a capital gain. The CRA wants their money.
Yeah, I mean, a capital gain's not necessarily a bad thing as well. It means that you've made money on the property. And you did mention a vendor take back as a way to reduce capital gains on sale. What is a vendor take back?
Yeah, so a vendor take back is, it's a financing strategy more so for the buyer of your property. So if you're selling a property, and this happens more, not in single family homes necessarily, but like rental property, 3, 4 units, 5 units and up, or commercial real estate, where you as a seller don't necessarily need all the money from the sale up front, right? You just want enough to pay off whatever debt you have, maybe a little bit above that. And so you allow the buyer to buy it with a vendor take back. And that allows you to spread out your capital gain over the term of the vendor take back. So it's really a win-win. I'd summarize it as one tool in your tool belt for selling and buying a real estate property. It doesn't always work because some sellers, like if you're going to go buy a principal residence or you want to reinvest into more properties, you might need all of that money from this first property sale right away. But if you own multiple apartment buildings or multiple properties and you are happy with the price that you're getting, but you don't need all the cash right away, you might give them a 2-year, 3-year VTB. And now, because you're able to bring in portions of your capital gain over a number of years, that might not push you into the next tax bracket, which means you end up saving in tax on that sale.
Awesome. Yeah, it's a much more complicated subject, right? If anyone has any further questions about that, feel free to drop it down below. But we're gonna move on to the next question because it's flooding in. We'll try our
Love
best
it.
to get to everyone's question. What can you deduct in the year of purchase? I assume this is for a rental property. Closing costs, land transfer tax, legal fees, title insurance, etc.
Yeah, this is year of purchase, or I guess it could relate to year of sale. Well, probably year of sale is a separate question. But year of purchase, you'd be looking at, like, I'm assuming it's not a flip, it's a buy and hold. You are essentially able to deduct anything that is like a standard expense incurred against the rental income. There are some items like closing costs, land transfer tax, that will actually be added to the adjusted cost base. Legal will be added to the adjusted cost base. Those will not be expenses that will offset your income in that year. And then there's some things that are like we kind of make a decision on with some of the smaller fees, the title insurance. Those are typically expenses that you can offset against your income. But some of the bigger items don't actually help you that year to save on taxes. They're going to help reduce your capital gain when you sell that property down the line.
Awesome. And I think this is a good way to transition. I see your questions, guys, but I think let me open it up. Here. There we go. This is a good time to transition into this question here. Can you explain the difference between capitalizing an expense versus deducting it for real estate investment? And how do you decide which one to do?
Yeah, so there are CRA rules, and one of the documents I share with my clients, because honestly, Austin, I get this question all the time, is I actually refer them to the CRA guidance, where the CRA has examples on both types of costs. Essentially, at the end of the day, you are able to benefit and reduce your profit from a rental property when you have an expense. So that's like, if you repair something, if you it's just like maintenance in nature. If you're painting something or fixing some floors or fixing a window, those are all like in-year expenses, as I call them. You get to put them as an expense on the T776 that year. Whereas capital items are larger items. Those are like major rentals that you're doing. If you're adding a second suite, if you change a whole roof, if you're putting in new windows and doors in the whole property, those costs, unfortunately, you don't benefit from in their entirety that year. You add them to the cost base. You essentially set them up as an asset on the tax return, and then you get the benefit from them slowly as if you depreciate them, right? So one of them is like maintaining the existing use of the property, and the other one is adding value to the property, and that's when we capitalize things. So this is like there is some grace sometimes, like if you're buying, you know, inexpensive appliances, technically it could go into one or the other, it could be treated. So there are some items where once I see the whole kind of T776 from the investor, then we make decisions, and sometimes they make a final call on which way they want to, which side of the fence we want to land on.
Awesome, awesome. That is key, not to over expense everything. I remember I did that, got audited, and the CRA was like, you should capitalize that. And I had to end up paying taxes back. Next question here. Here you go. Oh, sorry. We're moving in order, getting questions on Instagram and Facebook. How do taxes work for Airbnb properties? Does it differ if the property is being house hacked? So house hacking meaning you live in the property, but you're renting out the basement.
Yeah, so if you're house hacking, there are three criteria that you have to be careful with in order to preserve your principal residence capital gains exemption. Number one, you want to make sure that that house hack, the rental isn't the primary use of your house. You don't want to do structural changes to that second suite when you're renovating it, if that's what you have. And number three, you don't want to claim depreciation. If you stay out of any of those three items, then you can have a house hack and you preserve your entire capital gains exemption, and you just claim that income and the share of the expenses in terms of your whole property on your tax return. It just goes like a regular rental property. Short-term rental, it can get a little bit fuzzier depending on if you're earning income from the property or if it's truly a business and you have a number of these and you're providing additional services. So that's when, you know, we're going to decide how we put that on your tax return, if it's going to go on a T2125 or if it's going to go on a T776. But at the end of the day, you know, most of the short-term rentals that we claim on individuals' tax returns are just going on the T776 as a regular rental property. The only difference is you're going to have some additional expenses like consumables and like turnover cleaning that you probably wouldn't have if you're house hacking and you just have like a long-term rental in the basement.
Awesome. Next question here. From a tax standpoint, when should you consider incorporating? And what are the pros and cons of incorporating? Let's take this two ways. Let's talk about this as a real estate professional, like an agent, for example, and also as an investor.
Yeah, so in the first bucket, if you're an agent or any other self-employed individual, there is really no tax benefit if you incorporate. So you set up a PREC and you earn commission income. It goes directly from the brokerage into the PREC, and you pull out all of that money during the year. You will end up paying the exact same tax whether you were not incorporated or whether you now have the PREC. The only difference is you've paid, you know, I like to estimate that it's anywhere between $4,000 to $7,000 per year to set up and maintain and do bookkeeping and file a corporate tax return for that corporation. Where it does come in, like some of the pros of having something like a PREC is if you are earning so much commissions, but you don't need to pull out all of that profit, all of those commissions from the corporation throughout the year, because now you're literally paying the lowest tax rate you can pay anywhere on those profits that you leave in the corp. In Ontario, you're paying 12.2% small business deduction active income rate, which is amazing. Like you're not going to get that tax rate anywhere. I've seen too many examples where, you know, realtors or self-employed contractors or other self-employed individuals get into a corporation because they've been told that it's a good idea, but then they need every single dollar for living expenses, for car, for groceries, for mortgage, and then they end up paying the same amount of tax, but they're just on the hook for like three, four, five, six, $7,000 every single year to do everything that's needed for the corporation. On the second part of it, for an investor, I typically see, and you know what, this is an answer for everybody, but I see most investors that own between one and three, one and four rentals, they own them in their personal names. A lot of things are easier, simpler, like bookkeeping and record keeping. You don't actually need a bookkeeper. You don't need to use a software like QuickBooks Online or Wave. And if you feel like you need a corporation, I definitely would probably suggest a corporation if you're buying like an apartment building, or you have plans to invest in a large portfolio, or you're investing in like a commercial building. Probably a corporation or multiple corps might be a good idea for you, or you're bringing a lot of partner money in because you're doing development, things like that. You just want to keep in mind that in a corporation, real estate income is taxed as passive income at 50%. So any profits that you have, you're literally paying like one of the highest tax rates that you can on any of that profit. So once again, Austin, these are very, specific answers that I would give to different people in their scenarios. They can reach out to me if they want to kind of dig deeper into their situation, but that's a high level.
Awesome. Really appreciate it. And that is the moral of the story for taxes. It's very situational based a lot of times. So again, none of this is tax advice. Everyone's personal situation is different. If you want tax advice, make sure to reach out to Michael after this call. So next question here. Is there a specific way you should keep track of capital expenses for when you sell the property, even if it's 10 years down the line?
So I see two main approaches to this. Number one is putting all of the information into your tax return from the year that you purchased the property. So typically you would allocate a value to the land and allocate a value to the building. So let's say 20% of the land, 80% of the building. If you have two owners, you're going to split that 80%. And now I'm getting into the weeds. I don't want to lose you guys, but you're going to be essentially option one is to put all the info into the tax software, and that's going to roll forward every year. So then when you sell the property, it's going to be there already. Number two, which is actually the approach that I use with most of my clients, I use just like an Excel template. It's a tracker. We put in the purchase price, all the expenses incurred on the purchase, land transfer tax, legal fees, closing costs. Then we track all the capital additions. And so you definitely want to do this from the very beginning. You don't want to be catching up 9-10 years later when you're getting close to selling. And then when the property sells, now we update, here's the realtor fees, here's the legal costs again, other closing costs. And we've been tracking all the capital additions that we've done over the years. And now it's really easy to see, hey, here's our capital gain. Here's the inclusion rate. Hopefully the 66 2/3% doesn't pass. And we can just simply do a 50% inclusion rate calculation. Here's how many partners own this property that we allocate across. And away we go. And then we just take that info from that Excel summary and we put it into the tax software. But definitely a best practice, either on your own or work with your accountant. I push this on all of my clients to keep that tracker going from day one of your ownership of the property.
Oh, I realized that I was muted. Can you hear me now?
Yeah, you're good now.
Perfect. I was going to say it's never too late to get started. So even if you're a few years behind, it's easier to get started now than, to your point, to catch up 9 years later.
I hear you.
Next question here. I'm trying to find out which questions to best ask to go in a logical order. Okay, here. We were talking about incorporating. So what are the issues of moving a rental property title from your personal title to an incorporated business?
Yeah, you know what? I've had a number of people consider this. To be honest, the amount of them that have actually gone through it has been like very small. Almost, I think there's only been one or two. I actually had a good chat with a lawyer that works an accountant that works a lot with family trusts and a lot of reorgs. a lot of like passing assets down to kids. And this is a topic that came up. And, one of the biggest issues is that you're basically needing to pay land transfer tax again. You can do a Section 85 rollover, I believe it's called, where you can defer the capital gain on that transfer because you're changing the ownership. You're taking a property that's owned by you or you and a spouse, and you're essentially moving it into a separate entity, which a corporation is. So unfortunately, you will most likely 99% of the time be on the hook for land transfer taxes again. So nobody wants to pay, 5, 10, 20 grand again. So they end up just kind of sticking with holding that property in their personal name. There are specific situations where you just got to bite the bullet, and it does make sense. I've seen people going through separations where, at the end of the day, they just don't want to have any assets in their personal name. Or as they scale, they want to have this separate entity that holds their business income, self-employed, and any assets that they own. They just don't want anything attached to their name. And if they own some properties already, they might want to, be okay with paying the land transfer tax again. But you basically want to work with an accountant and a lawyer to understand all the implications of making that move.
Awesome. Perfect. And speaking about tax efficiencies for children, if you wanted to buy a property for your kids, what's the most tax efficient way to do so?
I don't think there's a secret, bullet here. I believe you need to be, I mean, you might know the answer to this, Austin, 18 or 19 to be able to qualify with your credit to obtain a mortgage. You definitely need to have some planning in place in terms of income and having a credit history for the child back then. Obviously, you might need to have a parent as a guarantor for that first purchase, but it'd be the same exact decision as if, a 25-year-old or a 30-year-old is buying their first property. Should I buy this in my personal name? Should I buy it in a corporation? Has that child been able to contribute to an RSP, to a first time to their FHSA, where they could go into those buckets of money and use that to help with a good part of their down payment? So you know what, I'd say if you have kids and like our kids are teenagers, we're planning all of those things. We're looking at the government programs that are available, the RSP, first time home buyer, the TFSA, the FHSA, and we're asking ourselves, how can we, when they're of age and they can sign up for those programs, get them into those programs, put some money into those programs, and also plan, like, how is this child going to have a T4 as early as possible, or multiple T4s when they're 18, 19, 20, and a credit history and a good debt to income ratio, so that they could either stand alone or with the help of a guarantor get into that first property. In terms of tax efficiency, like, it is what it is. Afterwards, we're going to make sure that they gain access to all their expenses and that they're claiming everything that they should. They're going to get their first time home buyer tax credit when they file that first tax return, which is doubled a couple of years ago. So we're going to make sure, like me as the accountant, that they get all the money back that they should be in the first year after the purchase that we file their taxes.
Awesome. Let's see what's next. Ooh, this is a cool one. If you travel to, it's blocking your face. That's okay.
That's okay.
If you travel to foreign destinations to look for real estate investments, can you share any tips to ensure expenses are accepted by the CRA? This seems like a great way to increase expenses and reduce taxes on profitable properties in a corporation.
It sounds like somebody is cold right now and they're going on a vacation and they want to expense it. I would say, Austin, you know what? Treat this as anything else. I get so many questions about, I own a couple of rentals. Can I write off vehicle? Can I write off meals? If I stop at McDonald's, can I write off like other expenses like that? And the answer is similar to this. Like, first of all, it needs to ask yourself, if the CRA reviews this, if they audit this, if they want to see my documentation, can I prove that this was expenses incurred to earn rental property income or business income. Like if you're a flipper and you've actively looked at Texas or Florida or Costa Rica or any other country, and these are business trips that you can truly support, and you're, this close to buying a property there, chances are you probably won't have a hard time proving if it ever gets, challenged, or you get pushback from the CRA, or a review or an audit, which is the next level of a review, comes in. But if you're just, going on a cruise, and there's, I don't know, you did one Zoom call from there to talk about real estate with somebody, and that gets questioned, and you really can't prove how that cruise for you or your family really allowed you to earn business or investment income, that'll be a harder thing to prove. But foreign travel is allowed, like expenses incurred in Canada or in other countries, if you can make that link.
Awesome. Seeing your questions come in, guys, we will try our best to get through everything. Um, this was a question that was asked on Instagram when we posted the little post that says drop a question below. Can a professional corporation, for a doctor or realtor, for example, pay part of an individual's mortgage if the office is based out of the house? Can I claim a percentage of utilities as a business expense as well?
Yeah, I'd say this is a pretty kind of specific scenario. I would probably advise that the way that you would do this is have a lease in place between the individual and the corporation, where you're essentially leasing a portion of the house out to the corporation. So then that corporation uses a part of that property for their office, whether it's 10%, 20%. Maybe you include utilities in that, right? They're responsible for a percentage of utilities in accordance with that. But you want to document it, similar to that, travel expenses question. If it makes sense and it passes the sniff test, if it ever gets challenged, whether that corporation for your doctor or your realtor is renting out your basement or renting out or leasing out a space from anybody else, it's the same thing. As long as it's documented and it's at reasonable market rates and it makes sense, then it's all good. Where you kind of get into a gray area and potential issues is when you're not reasonable and you're trying to do some funky stuff. The shareholder of the corporation might be on the hook for like additional shareholder benefits. So, the corporation is going to get some additional expenses, but then the shareholder ends up being taxed additionally because they did things that were not done at market rates, or they do things that just were not allowed.
Awesome. Next question here. Can I deduct monthly cost of real estate investing coaching courses from my income from co-hosting short-term rentals of a property I don't own? So I assume they're Airbnb arbitraging, but they've also maybe taken courses on how to Airbnb arbitrage, for example. Can they write that off?
Yeah, this is an interesting one because there are a few potential places where we could put professional development in on a tax return. I'd say it's a little bit easier maybe in a corporation to do this on a personal tax return. At the end of the day, if you're running a business and you are, putting self-employed income on your personal tax return, or you have a corporation, you can make a case that I had to do this course, I had to pay a coach, I had to attend this in-person session, I have to pay for my Zoom membership, whatever it is, because that's allowing me to earn the income. Where it gets difficult is if you own like one long-term rental, or you have no rental properties, or you've earned no active, self-employed income, and now you're trying to put in a $5,000 course or a $2,000 course. You actually don't have enough income or enough properties to prove, if it's challenged, that this was necessary. Like if you have one rental property and you're renting it out for $2,000 a year to $2,000 a month, you have $24,000 in income for the year, and then you have a bunch of expenses that bring your income down to zero for the year, but then you want to put in a $10,000 coaching program. Can you actually argue, if challenged, that you needed that entire program and you're going to expense it on the T776 for that one rental property, because without that you wouldn't have been able to be a real estate investor? That's where it gets a little bit fuzzy. So I usually deal with these on a specific basis for each investor, and sometimes we prorate a part of their, coaching or things that they're paying for to earn investment income or to run a business.
Yeah, what it sounds like a commonality between these answers is put yourself in the shoes of an auditor, right? And if someone was to tell you, "Oh, um, I wrote this off because of XYZ," and you were to take a look at their income and their expenses, would you believe it if you were an auditor, right? Instead of putting yourself in your own shoes, think the other way around.
Yeah, 100%. One of the other questions I often get is about like CRA audits and replying to the CRA. And I've developed numerous templates with my letterhead that I use to respond to the CRA when they have any questions for clients. And, I've been an internal auditor and an external auditor. I know ideally how I want information packaged. So that's how I share that information. The CRA is very regimented. When they're going to send a review letter to you, it's going to dictate like 5 or 2 or 10 things that they want from you. Just reply to every one of those items. If something doesn't apply, that's fine. But if they see a response come in that's organized and regimented and you're not missing things, you're not skipping things, if they want your SIN number or the case file number on every page, put it on every page. Like that stuff is going to get you points with the CRA rep that picks up that file on the other end. You can usually submit everything through my CRA account. It's very easy. So that goes a long way. Being organized with your bookkeeping, with the way that you package things up for your accountant, with the way that you respond to the CRA if you ever have to, that goes such a long way in everything to do with taxes.
Awesome. Thoughts on paying down mortgages to continue to refinance and reinvest cash flowing properties? Thoughts on paying down mortgages to continue.
So like refinancing versus not refinancing.
I may have typed that out wrong because give me a second. Let me just double check. Actually, we'll move on to another question. As I don't worry, I'll get back to this. I just want to make
All
sure I typed
good.
it out correctly. Um, here you go. When does it make sense to open a personal real estate corporation, PREC? How does that affect my taxes as a realtor?
You know what? Definitely a good one. I get this all the time. What I see is when a realtor reaches, I'd say like 80,000 to 125,000 in annual commissions, they start thinking about a PREC. Where the people that pull the trigger the most often are the ones where typically there's other income in the family, in the household, maybe the spouse, or they have another business, or they even have a T4 income still, where that other income is able to support much of their monthly household expenses. And that PREC is a great vehicle for saving on taxes because they don't need to pull out that 85, that 100, that 125. It's okay if they pull out some of it through salary and dividends throughout the year, a couple of thousand a month. But if they can leave a chunk in that corporation, in that PREC, and pay the lowest tax rate, 12.2% in Ontario, that's a huge win. So it really requires looking at the whole family picture. That's what I love about being an accountant that really, asks a lot of questions. It can see the whole picture of what you have going on. What's your, like, how many kids do you have? Are they working? Because then I can give you specific advice. But if I had to generalize, when they're hitting 6 figures, that's when people start looking at a PREC because they're like, oh my God, I'm paying so much tax here. And I'm paying, if you're making 200 grand as a realtor and you don't have a lot of expenses and you're in a 45% tax bracket on the personal side, that's a lot of money. I think you're on mute, Austin.
Oh, yeah, I was saying we'll get back to the question before because that was my mistake. I did mistype it. Here's the corrected version. Thoughts on paying down a mortgage versus refinancing and reinvesting to buy more cash flowing properties. Maybe we can answer this in two directions, right? From a tax perspective, of course, and the other perspective is maybe answer it from, I know you've done coaching, so you've seen people do this as well. So from like a personal risk tolerance.
Yeah, definitely. From a tax perspective, if you are paying down your mortgage, I have less interest expense to work with because there is just less expenses in that category. If you refinance and you use that money to invest in stocks, bonds, other rental properties, we can continue deducting that additional interest, right? So that's the kind of tax perspective. From a coaching, advisory perspective, it does come down to your risk tolerance. I know a number of investors and clients that as soon as they have any opportunity to refinance, to go up to 75%, 80% loan to value on a given property, they will do that because they feel like, hey, I'm not overextending myself. I'm very comfortable adding this additional mortgage piece to my, liabilities of my balance sheet. I know how much I can make if I refinance this 80, 150, 200 grand from this property. It's going to be a tax deduction for me at the lowest rates anywhere, whatever you're paying, 4%, 4.5%, 5%, 6%. If they can make ROI higher than that, that's definitely a case, assuming they know how to find good deals and they can make a higher ROI than the cost of that capital.
Awesome. The $1 million question. We've heard that audits are becoming more common. Is that what you're seeing yourself as well with some of your clients? And what trends are you noticing in the real estate world when it comes to audits?
I'd say I probably expected, and knock on wood, I don't want to jinx anything. I think I expected a little bit more to come down the chute, and maybe it just been my client base that I haven't seen too much come through. But we stopped seeing a couple of years ago, CRE was really looking at multiple years of rental losses. So if you had 2, 3, 4 years of losses in a row, which was not hard to do when interest rates started spiking, they were sending these letters and they wanted you to prove that you had a reasonable expectation of profit. And it's hard to prove that when literally your interest expense for the year alone was more than all of your rental income for a property. But I've seen less of that. Where they are definitely banging on the doors, HST. If you don't file your HST late, if you haven't registered for HST, by the way, is a whole rabbit hole on its own. I get so many questions on HST. Should I register? Should I not? When do I register? How does it even work? Like, what if I am running short-term rentals, but I should have been registered for HST, but I didn't do it. I forgot about it. I didn't know. All of this stuff. When I sell my short-term rental, am I going to be paying HST on it? That's a whole rabbit hole, but definitely HST is something they are auditing 100%. Self-employed people, they're always going to be looking at. Like if you're making 150,000 gross and you're claiming 148,000 in expenses, sooner or later they're probably going to look at you because not many people can bring in that much money and still have that much in expenses, for 1 or 2 or 3 consecutive years. Realtors, those are, some of the common areas that I've noticed it in. Flippers, like we had the anti-flipping tax that came in 2 years ago at the beginning of 2023, because a lot of people were doing that old trick of, buying a property, holding it for 6 months, 9 months, 10 months, and saying, hey, this is a capital gain. So they wanted only half of it to be taxable. CRA said, no, you're paying full tax on this. This is active business income. So there was a lot of reviews in that area. We still continue to see some of that. But yeah, those are some of the key ones off the top of my head that I can mention.
Let's open up that rabbit hole because the next question is, do you need to pay HST on fix and flips and Airbnbs when you sell the property? I know you mentioned it briefly, so let's jump into it.
Yeah, so I'll cover the second part of it first. I think it's a little bit simpler. Airbnbs, this rule's been around for a while, but the court case around the condo owner in Ottawa a couple of months ago that made the news where they changed their Airbnb from long-term or their condo from long-term rental to short-term rental for only a year. They held the property for 7-8 years. They only did Airbnb for 1 year. When they sold it, not only did they pay a capital gain, but the CRA audited. They went all the way to the tax court of Canada. The owner lost, the CRA won, and they said, you also have to pay us 13% of the value of the sale of the property on top, which is like HST. So Airbnbs, you want to be careful that if you change the use of a property that you own primarily to a short-term rental at any point that you own it, it becomes a commercial use of the property like Airbnb, VRBO, and now you are probably on the hook for 13% when you sell that property, unless you can sell to another person that is going to continue that use. So it's a little bit easier, let's say, with a cottage or with a commercial unit, like where you have a building and it's on the main street. Chances are the buyer might consider running it on Airbnb. They're going to continue renting to a commercial tenant. That's easier because now it becomes a flow through, right? But if you just own a residential property and your primary use for consistently is an Airbnb, that's when you're kind of in that gray area. The first part is also specific. I've talked to multiple accountants about this because I get a lot of questions on it too. The thinking is that, if you do the odd flip and you don't do a substantial renovation, you just do a lipstick flip and you have a full-time job, you're just doing this off the corner of your desk, you should not have to register for HST. You just pay active business income on that flip, right? And this is like disclaimer. Please speak to your accountant about this one. There's definitely a lot of gray, and you want to present your specific situation here. If you become an active flipper and you're doing multiple flips and it starts becoming like a good part of your living and your income, chances are you will be paying active business income, and there's a good chance that you will also need to collect and remit HST on that. Obviously, then you get the benefit of input tax credits, but this is not a cut and dry scenario. I wish it was, but unfortunately, you want to be talking about your specific situation with your advisor.
Okay, so let's. Hopefully, this will be a quick answer. I don't know if it will be, but with Airbnbs, let's say I'm an owner of a property, and you come up to me and you want to arbitrage my property, right? So you want to rent it from me and list it at Airbnb. Am I the owner, because it is a lease, right? I'm getting rent payment from you, but you're going and using it for commercial purposes. Am I supposed to pay HST when I sell that property, or is it considered just a regular residential lease?
So the CRA will likely, if they choose to go after those types of setups, let's say 1 or 2 years after a bunch of those properties have sold, they now get Airbnb data and they see that that property was on Airbnb 100% of the time or 80% of the time. They're now going to decide, okay, who's the easier person to go after? Is it the arbitrager running it personally or through a corporation, or is it the owner of the property? In my mind, and this is a lot of assumptions, I would think they would go after the owner because the owner is on the land registry, he's on the ownership. They can definitely tie and say this property that you own was used in a commercial manner. You now sold it. We want you to pay 13% of the sale price because for a consistent period of ownership, you ran it in a commercial manner.
And I think that would make sense, right? Because if they did not do that, I could just have my mom open up a corp, rent it from me, and have my mom, arbitrage it. But I just operate in the back end. So it
Yeah,
makes sense.
I probably had calls with 10 Airbnb arbitrageurs when this news article came out in Ottawa, and
Yeah.
they were all worried about the same thing, either the implications for them or, oh shit, I never, my landlord, the one that I'm leasing from, and all they have is a long-term lease with me. They don't know about any of this. Like, I never told them about this. I didn't know about this rule. Like, what do I do now? And some of them have actually canceled the whole arbitrage situation that they have because they just wanted to cut ties with that unit, with that property. They didn't want to get either themselves or that long-term rental, the owner of the property, into hot water down the line. Other
Right.
people have continued, and honestly, I think some people are continuing with the intention of never claiming and paying HST, hoping the CRA never comes after them. It's not like it is kind of, putting your neck out there, but those are some of the things that I've heard.
This is a quick question. Is strata fees in a condo considered an expense?
Strata is like maintenance
Maintenance.
fees.
Yeah.
Yeah, it is. It is. Yeah. Like that is, one of the expenses that you are incurring to earn that rental investment income. And the reason that's a higher expense is because you probably have very little utilities or other expenses to offset it.
Right. And just to be clear, mortgage payment is not an expense. It's only the interest component of that mortgage payment that's an expense.
Yep. 100%.
If I turn my rental to a primary residence, for example, let's say I rent it out for 1 year and then I live in it as a primary residence for 5 years, and then assuming they sell the property, how does capital gains work in that situation?
Yeah, so anytime there's a change in use, I suggest that investors do get an appraisal or a realtor's opinion or multiple realtors' opinions. I think we've chatted about this, Austin, before, just to kind of draw a line in the sand. Okay, I have a change in use. I want to know what the value is. I know how much I paid for it. I need to know right now, and then I'll know how much I sell it for eventually. When you have a change in use going from primary to rental or rental to primary, it really depends on where you live and whether you own during the years that that property is a rental property, whether you rented it first or whether you rented it after living in it. And so if you were renting somewhere else, or you lived with like your parents, let's say, or you lived with a partner during the years that you rented out this property that you then move into, you can actually claim, like, shield previous years when you were renting it with your capital gains principal residence exemption. Or if you rent it after living in it, you can shield those years after it, up to 4 years or the 4 years before that. So I don't want to lose people, but I really ask for a timeline of events and where you lived when there's been a change in use, in and around the subject property that we're dealing with. And there's been multiple clients that we filed late changes in use. I just got an email today. Somebody didn't know about the filing a change in use, which allows you to defer any capital gains until the year that you sell. It's just a letter that we sent to the CRA. There's specific info that we include. So in this case, if this person was renting for those previous years when this property that they're talking about was a rental, and then they move into it, they could technically designate all of those previous years when this property was a rental as their principal residence as well.
Perfect. And sorry, I might have missed this, but the capital gains is calculated at the time where there's a change in use. So let's say it was in a bad market and prices dropped, and you decided to move in, then hypothetically there wouldn't be any capital gains, or not necessarily.
Yeah, so the change in use allows us to defer claiming any capital gain, or I guess capital loss, until a future point in time when the property is actually sold. That's the magic of the change in use. Not only do you lock in that value because you have the appraisal or the realtor reports, but you're also telling the CRA, please delay the recognition of any capital gains on this property. I still own it. I haven't sold it. I don't want to, pay capital gains if applicable. So technically, there is no capital gains at that change in use time.
Right. But if they were to calculate it, it would be based off of that time where they changed it, right?
Yeah. If they had lived in a principal residence for all those years that this property was rented, then they're probably designating that principal residence as their primary. But if they were renting and they own this rental, even though there's a capital gains calculation that would show a technical capital gain, we can actually cover up all of that and use the capital gains exemption by going backwards. And then there actually might not be any capital gains to pay. So it really is specific to every single individual.
Awesome. We're down to our last 7 minutes over here, so we'll jump on into the next question here. What is the Smith maneuver, and how can it benefit me as a real estate investor in terms of taxes?
So I think, Austin, you are a big proponent of this too. I know a couple of other people in our network that are always sharing that. Like, it is great when you truly understand how to turn as many of your expenses to be tax deductible. And in this case, we're essentially taking mortgage interest that might not be normally tax deductible, like from your regular mortgage that you're paying on your principal residence, and we're making it deductible. So in this case, The most common way that I see it is somebody sets up a HELOC. So they have, a good amount of equity in their property, and it's a readvance. They also have a readvanceable mortgage, and then every month, as they pay off some of the mortgage, they now incur and they have more of a HELOC balance. They have more debt that now becomes tax deductible. So I always ask my clients, like from my account, as an accountant, I just want to know how much mortgage interest did you pay on this rental property during the year, and how much other holding costs, carrying charges did you have on money that was incurred to earn investment income. And so if you're doing, whether you call it the Smith maneuver or cash damming, whatever you want to call it, you want to set it up right, because as you start taking money out from your HELOC or from an unsecured line of credit, you need to have a really clean paper trail to show, hey, this 100 grand that I'm paying 6% on, 6.5%, 7% on, because the rates are a little bit higher than a regular mortgage. This is used entirely for this rental property or for this business or for these stocks. Once you understand that and understand how to set that up in terms of the back end bookkeeping, now you've turned as much of your regular expenses into tax deductible expenses. Hopefully I didn't lose people. This isn't always easy to explain, and it takes longer than like a minute summary.
Yeah.
I feel like most people need examples and like a Zoom call or a whiteboard to really help them understand how this works.
If you guys are interested more on that topic, and a lot of you guys reach out about it, maybe we can host some sort of webinar where I'll go over sort of like the financing structure of it, and then you can go over the tax deductibility of it, right? Because it is a very powerful strategy once you learn about it, but it's not for everyone, right? Like it depends on your tax bracket as well.
Agreed.
Cool, perfect. So this question came up, like a variation of this question came up a few times. But how do you minimize taxes when passing property down to your kids? Like, let's say you pass away, some sort of inheritance.
Yeah, I don't think there's a silver bullet, unfortunately. Probably the most effective way is also the one that requires the most planning and probably costs the most. It's having a family trust, which not many people have. But if you're able to understand how a family trust can work, and if it makes sense for your situation, that's when, even when you pass away, there is no like capital gains. But essentially, assuming you don't have, a complicated family trust, or you've never understood or asked questions about that, when you pass away, you are deemed to have disposed of all your assets. So all of those assets, unfortunately, you need to pay capital gains on. The only way that you can transfer your principal residence or any rental properties tax-free is to your spouse, right? Like your spouse can continue owning all of those. There is no capital gains to pay. When your spouse passes away, that's when the capital gains obviously get paid by the estate. So unfortunately, if your kids are going to benefit from those assets and there's no, more in-depth family trust setup, you are having your estate is going to pay capital gains tax on those properties, and then your kids are going to get the leftovers. Where I've seen some strategy is, if you know that your kids are probably not going to want to be investors, and you can time things. We can't always guess when we're going to pass away, but you have a bunch of years left. You might want to sell a property or an asset or multiple assets earlier, maybe even give a vendor take back to the buyer, minimize your personal taxes or your corporate taxes on those sales, and then give your kids the cash, the leftover cash. So now you're not waiting until you pass away and 3, 5, a number of your rental properties are all sold in the same year. You're in a higher tax bracket. You're paying more capital gains. Instead, you're smoothing out the sales while you're still alive, and then you're passing the leftover capital, letting your kids or whoever else is in your will do whatever they want with that money. So there is no like direct inheritance tax, but there is the capital gains and any other taxes due to the deemed disposition that happens at your death. So you want to plan as much as possible before you are ready to pass away, if you will.
What a morbid topic. Last question here. This is more of a crystal ball. Feel free to skip if you feel like it's not, you can't. I guess it's something that is not worth speaking on, but it's more of a relevant news topic, right? What are the chances that the efforts to stop the CRA from collecting on the new capital gains tax? And why don't we give a little bit of background on that? From my understanding, the CRA implemented capital gains tax of 66.7% in corporations when you dispose of assets there, but it never got passed by Parliament, and so it was never supposed to take into effect, but they are still collecting on it. And all of the parties, even like I think Christina Freeland said that she's going to cancel the 66.67% capital gains tax. But the CRA is still collecting on it. And I believe there's a tax advocacy group. I don't remember what they're called or what their name is, that are suing the CRA for collecting on it. Yeah, I mean, I guess, what are your thoughts on it?
Yeah, I personally do believe that it probably won't get passed. It won't be finalized. It won't come, into law. But unfortunately, we're in this middle ground right now where a lot of individuals, first of all, sold properties before June 25th, 2024, to try to still pay or have the lower inclusion rate if they own in corporations. Because in corps, you're being charged a higher proposed rate from the first dollar. Personally, it's over 250,000 per year if that was your capital gain. I don't think it's going to pass. I think we just need to keep on putting pressure through any of these donation groups or advocacy groups to let our politicians know and the CRA know. Basically, every taxpayer that's impacted by this has a decision. They could, if they think it's going to pass, they could pay the money and pay the tax, and they're just going to get it back when the rules don't pass. Or they could take a chance, not pay, and hope that they guess right and they never had to be out of pocket for this money. The rules never came into law and we're all good. There's no interest and penalties. The worst case scenario is if you had significant capital gains, you assume and guess that, oh, you know what, the conservatives or whoever, the new government is not going to go ahead with this. They end up going with it. And now you're 6 or 12 months late on paying your capital gains, and you owe a lot of money on the capital gains themselves, and then interest and penalties. It's going to tack on quite a little bit there to your tax fee.
I guess it's odd right now because I'm just looking online and it looks like the CRA is enforcing it. So they've asked someone
Mm-hmm.
to pay the higher amount, even though again it
They
never
are.
got, it never got approval. It never passed.
Well, welcome to the tax world of an accountant, Austin. Like, we've had underused housing tax that was delayed twice. It's been a mess. We've had the trust reporting rules, which now got pushed to 2026 for all intents and purposes. Now we have this whole debacle, is the best way to summarize it, with the capital gains changes. Like, there are so many moving targets. I think this just really summarizes why, if you don't feel comfortable doing your own taxes or having a family friend doing it, definitely, link arms with the right accountant, just like you don't want to work with an awesome mortgage broker on the financing side, so that you're not in no man's land trying to figure stuff out. Gone are the days where we could just, piece things together on a simple personal tax return. You definitely want to be getting the advice and staying on top of all these rule changes.
Awesome. Michael, really appreciate your time here today. A lot of value, a lot of knowledge being dropped. I hope we answered all of your questions, guys. If you have any more questions, feel free to reach out to Michael directly. Do you do consulting calls as well? Yeah.
Yeah, there is no wrong window. You know what? Send me a DM on Instagram. Send me an email at my email address. Message me on Facebook. I'll give you the options. We can jump on a quick call, no fee. We can do a consulting call. If you want to become a client of mine, I can give you a quote on that. All of the above works.
Awesome. And your contact information is down below, as you guys can see. Well, my name's on there first, but it'll get to your name. And yeah, if Michael again is amazing to work with, I highly suggest you guys to follow him on Instagram, because you continue to do these really cool Q&As, right? Where you post questions that you get on your story so people can learn along the way. So again, follow Michael on all of the social media down below. Again, Michael, really appreciate you jumping on. Hope you guys enjoyed the session. And until next time, everyone, invest smarter and live better. Take care. All have a good night.
See you guys. Thanks, Austin.